Well, welcome back to three of the most underpaid people I know. And and by the way, not only underpaid because they're volunteers, but they work really hard. Now, I'm not complaining because I never learned to do anything else but work. These two guys know how to go on vacation and enjoy themselves. And yet they still come back and they have put hundreds of hours a year into doing what they do for you and certainly for me, because without their wonderful work, we would not have nearly the information and guidance that we're able to share. So, Chris Patterson, give it a wave so they'll know who you are, Chris, if they're first timers. Director of Research, and Daryl Balls. Well, you can wave if you're not, because you're the only one left. Daryl is our Director of Analytics. And the work that they turn out, I just think is amazing. In the case of Daryl, at a minimum, he updates about 200 tables every year, as well as working on projects for the future that have not been shared yet. And Chris's work with Two Funds for Life and the Best in Class ETF project, and all that he brings to this conversation in terms of perspective. In fact, both of these guys have a great perspective from what I know it takes to be a successful investor. So if we're in the world of each one teach one, then these two guys are teaching stuff that I think is in your best interest. So today we're going to address a couple of Q&As. We're going to talk a little bit about something many of you have asked about, and that is what things we're working on for next year. What do we have to offer in the future to keep you coming back? Uh, and also, we had a conversation just before this started, and I really wish that we had captured it at that point because it would be wonderful just to have shared what the casual conversation created, and that is about where we fit. And I think I'd like to start with that, guys, to talk about who it is that we're serving. I know when I started that conversation, I was talking about the problem I've had my whole life, and that is trying to help too many people. And when you do that, you probably, if you do help people, don't help them very well because you're trying to help too many different kinds of folks with different needs. But but I'm trying to learn, and these two guys understand the importance of doing the right thing for the right student. Chris, would you please just share the comments that you made about those three important areas where you feel that we're doing the best work and should probably be focusing hard and heavy on those folks?
Of course, you made the comment in our earlier conversation that you feel like you've used a shotgun for most of your life. You've been scattershot, trying to kind of hit all of the targets at once. And uh, in my mind, the foundation's actually been more specific, at least in a few different ways. I think the work that you have done talking to parents and grandparents who want to invest for a grandchild or a child, I think that's fantastic work. The dollar a day for 365 days, talking through what you've done in terms of a portfolio for that kind of an investment to make it both educational and risk appropriate for somebody with this long horizon ahead of them. So I think that's a really cool, focused amount of work on a very specific kind of investor. And then for me, my passion around Two Funds for Life, really applies, I think, most and best to a young investor who's just signing up for the first time to a target date fund and probably being defaulted into it at their employer and maybe starting to get curious about what else they could do. And I think that that is another very specific kind of investor who we've spent a lot of time thinking about because two funds for life, just the idea that you add a small allocation to small cap value could be life changing. And we've given people the tools to act on that and to learn from it, especially with the new calculator that I just created. And then I think both Daryl and I were drawn into your work because we were part of the third and possibly the largest group of people that the foundation targets. And that's people who are trying to learn and kind of have a little bit of an analytical orientation, who are either in retirement or approaching retirement, because that group of people have this urgent need to understand investing well enough to live off their investments. And it becomes less of an academic exercise on the side of a career and more of an urgent thing that's going to sustain life. And I think for that group of people, we also have targeted messages. So I don't think we've been as scattershot as you characterized it in our earlier conversation.
And Daryl, what would you add? And both of you guys are engineers professionally,
Very
uh,
much so.
and
Yeah.
you're here. Um, how do you view this group of people that we're trying to help?
Well, I think Chris nailed it in terms of the types of individuals that you're focused on. I, as he mentioned, I fall into the analytical type. I like to see the numbers. I like to understand how things work, how they move, how as you twiddle one little dial, something else changes, and how do things interact, and how can you tailor uh, your investment strategy to meet what your objectives are. And hopefully we've created enough data or representations of data and tools to allow people to do that. Um, I'm hoping that in the future we can continue to work on that and maybe help make the process a little more tractable for individuals, so that they can understand it and apply it to their own situations. But I think the analytical people that we look at, or that we target, the young investors through Chris's two funds for life and target date fund portfolio analysis that he's done. And then I think it's not quite as analytical, but I also think that the approach that you take in trying to help adults who want to help their children or other young people um, get a start in life, with your different approaches for how to do that and how you've documented those, are also very helpful and useful for people. It gives people another way to think about things and how to realize the power of particularly long-term, regular, periodic investing and staying the course.
So thank you both for those comments. Uh, a lot of people want to know what we've got on our palette uh, to continue to build the educational framework that we have. But before we go to that future, one of the things we talked about is the big challenge we have in getting people into our work. And I will agree with one criticism of our work, and I'm responsible. And that is, I know we have not done as good a job of showing people how to get to all of the important information on our site. And I have, in fact, I have one of the Q and A's. One of the Q and A's is from a fellow who said that he asked me whether I think that the small cap value premium is gone. that it is not showing signs of what he expected. And he said he actually pointed to the return of the small cap value from about 2000 to 2006 or 5, and made the point that we haven't seen that kind of return for a long time. Well, the reality is that kind of long-term advantage to small cap value doesn't happen very often. And we've gone out of our way to show that very clearly with our quilt chart that Daryl put together, that shows year by year how the major four equity asset classes have performed, and also shows in that quilt chart how 25% position in each one would have, what would it have produced over the last 90 plus years. But one of the things that people really dig into that quilt chart is you will see that it's questionable in the short term that we're ever going to know what should happen next, because it looks so random. But even in that randomness, you get long periods of getting heads in a row. Like when you're flipping a coin, you can naturally actually get quite a few heads in a row by chance. And there are higher, longer probabilities for that, but they exist. And so uh, we have tried our best to kind of warn people this isn't going to be easy, but we need to learn how to make that more obvious. And we also need to learn how to get you to see the most important work that we do in that educational process, which is the boot camp series. And our hope is that we'll be able to have an introduction when you come to our site, and you will end up spending the time to go through the boot camp series, because that I think will harden you to the realities of the history of investing. And can you guys think of anything else that we talked about that goes along with what we've addressed here so far?
Well, you called it an introduction. I think it should be an induction.
Ah,
The
yes.
induction to boot camp.
Yeah. Yeah. I
There you
think
go.
that's
Yeah,
absolutely
you're
right.
being drafted.
Yeah, exactly. The
Well, and
website could always be better
yeah.
organized. It's an ongoing challenge. And I don't know how we solve that, but making a lot of information easily accessible to new people trying to navigate it that's a perennial challenge for us. Yeah.
Yeah, and we talked a little bit about the kinds of people who follow our work. And we know, and I saw it when I went back to the Bogleheads conference here a week ago. How many people just love the numbers? I mean, they sat there for 3 days and looked at the table of numbers one after another, and they get it. And we know that in a way, that's the easy group to get to. That's also the group that more than likely already has gotten it before we get there, because they've been following John Bogle and communicating with other engineers for decades. But we're going to work harder. And I also want to talk about the questions you have asked about our projects for the future. And Daryl, do you want to just make a couple comments about what you got planned for the people who follow our work next year?
Well, one of the things I want to look at next year is what I call equivalent risk portfolios. If you are looking at a say a three fund portfolio or an S&P 500 and fixed income portfolio, total market fixed income portfolio, and you put put other asset classes associated with that, whether it be large cap value or small cap value or large blend, small blend. If you mix those things together in different portfolios, what happens to your risk versus return, or your return versus risk? And so I've got some ideas on how to analyze that and how to portray that data. One of the other things I'm looking at for next year is I've spent some time on it this year, and it's taken a little longer than I had hoped, but it's to take a kind of a deep dive at rebalancing periods, particularly for different types of portfolios with different asset allocations. Rebalancing has been looked at ad nauseum by many different people over the years, to try to find the optimal rebalancing period. And I'm not sure there is, well, I'm pretty sure there isn't an optimal a priori rebalancing period. But when you look at the time periods over history, and you see how rebalancing interval affects your long-term returns and portfolio growth, there are some trends and some indications there that maybe point you towards different regions, if you will, of how often or how frequently you should rebalance. Not that you should rebalance every 17.3 months. It's more along the line of, kind of, if you rebalance sometime in between here, and you'll be okay. It's not about trying to find the optimal. It's just not trying to do the worst. So that's something I'm hoping to get through next year.
That's
And there
great.
may be others that come up. We'll see. It's an interesting area for investigation.
Well, I always wonder what's going through your head at the beginning of each year when you're looking at those 200 tables. Although I suspect by now you've gotten some of that automated so that it isn't certainly as emotionally catastrophic as it was when you first walked through the door. So we do appreciate that. Chris, what about you next year?
Well, we met in August face to face up in Washington, and I thought it was a great meeting. And one of the reasons it was particularly interesting was that you, Paul, I think, came in with a focus on sustainability, on trying to make the work that we're creating last, and try to focus on the things that we can do that will have lasting value. And that means that they can't be things that require a lot of custom handwork from Daryl or me or you on an annual basis. And that was really focusing. And the hope is, I think, that we'll find somebody to take things that are manageable and that have reasonable crank turns on them, and they'll be able to keep them going after we're gone. I think that would be fantastic. That would be a great legacy. And so with that in mind, we talked about several different activity areas. One of them for me is the best in class ETF and mutual fund work that we've done. And that is even though it's very analytical and fairly objective, it's still a very manual process. And it would be difficult to automate, difficult to hand off, and difficult to have somebody else pick up. And so as we talked about it, we thought, well, what is it that we really have of lasting value that we want people to focus on? And if you could elevate it to the headline and not bury the lead, what would that lead be? And the headline would really be that as we've done this work over the years, and as the ETF selection has evolved, there are really two families of funds, the Avantis funds and the DFA funds, that we think are well managed from reliable sources that we would recommend people without any qualms, any reservations. We would recommend those sets of funds. And so if that's the case, then in many respects, all of the details around all of the other fund choices become a little bit of noise. If somebody really wants the lowest cost, they'll go to Vanguard or maybe Schwab or maybe Fidelity. There are zero cost funds too. If somebody wants the lowest cost from somebody with zero conflict of interest, they'll go to Vanguard because they're mutualized and they're owned by their investors. If somebody, wants uh, to go to a fund family, though, that is managed with this kind of focus on the academic work of Fama and French and the value of factors and having meaningfully diversified portfolios, Avantis and DFA really lead the way. And so they would be the safe recommendations. And so, with that in mind, I think we're going to simplify the work in the future, and it will become a very clear map of here are the funds from Avantis that fit the recommended asset allocations that we have. Here are the funds from DFA that fit those same recommended assets or asset classes. And I think it'll be easier for investors to use. And the only place where I think it gets harder is if somebody has a limited selection, if they have mutual fund choices that are different. But truth be told, we don't put as much time into those mutual fund recommendations. And so I think I think the real value is in the recommendation of those two fund families. And so that'll be a change, but I think it'll be a change for the good. It'll be a simpler story for people to understand. And then, with that same thought in mind, it has implications down the road. I think it'll change what I do in the portfolio configurator because that won't be as useful in the complex form that it's in. So that'll probably get simplified. The two fund for life calculator was created after we had this conversation, and it's very manageable. I can update it with the 2024 results in about 5 minutes because there's basically a fund return spreadsheet. Then there's a tool that calculates all of the necessary data to go into the calculator, and it automatically updates the calculator. So I can hand those three tools to someone, and on an annual basis, there's a 5-minute update. And so I think we're moving in the right direction, but it is a new way to think, and it's a good one. It's a good way to think because none of us are going to last forever. Although I hope you both do.
Well, that's great, Chris, and as I mentioned, certainly the website needs some work. Many of you have written to me, and you totally agree with me, and you've even offered to come help. And I just haven't had the emotional bandwidth to do that. But I will just say that for those of you who still feel that generous about the project and helping us, if you would drop me so I'll be updated on who might or might not be interested. Email me paul@paulmerriman.com and we can talk and be sure and include your phone number if you would. But we do need desperately to do a better job of presenting that information because these two guys have done such a marvelous job of creating it. The other thing that and really I think what Chris said is basically the same thing. We believe John Bogle when he says the key item is stay the course. And how are we going to tell investors 10, 15, 20 years from now what they should do in terms of staying the course? Well, things will have changed. When I started in this business and we had 8.5% loads on mutual funds, there was no such thing as an index fund. There was no ETF. There was no target date fund. In fact, there weren't really, as we know, certified financial planners. There was no CFP organization to train the planners. That didn't start until I think 1984. So things are going to change. And what is it we can leave behind that will still be meaningful 10 or 20 years from now? That may not be possible. The world may have changed so much that what we're hoping people will do with their life savings will be something very, very different than what would make sense today. But we're going to try. so that when we do move on in our lives, which eventually, one way or another, we do, that we will have left a legacy that will be meaningful to you and to your heirs, because we really think in terms of multi-generational teaching here to the extent that we're able to accomplish that. So, and I might add, one of the reasons that I'm involved at Western Washington University is not only because I want every student who graduates from the school to be financially literate. And right now, every student at Western is given access to an online source of information on financial planning and all the aspects of it that actually is able to teach regardless of whether you're a high school student with no information, or if it knows that you're graduated from college and you've had some experience with this, it takes you to another level in terms of the language and the teaching. It's called iGrad, and every student will be able to take that iGrad work, online work, software and database and all, uh, away with them when they graduate. And all of the alums at Western have access to that. So that is one way that our program, we have a Merriman Financial Literacy program on campus at Western, and I'm keeping my fingers crossed that Western will also figure out a way, as Chris and Daryl myself may have to move on in the future to whatever life we have left to do something else. If that happens, I'm hoping that we will get agreement at Western to support the work that we've created, so that it will be maintained after we are gone. We will see if we accomplish that. Working with big institutions requires patience and a lot of legalese, but that is one of the things I'll be working on next year, is to see what we can do to get that university to be supportive of us as we are supportive of them. Now, I do have, oh, and I've also got to mention, this will be an advertisement, so just take a second. I am making a presentation, and we'll have a link to it, with the AAII, the chapter, the Puget Sound chapter, online. You're all invited. The cost to get in is a donation to AAII. It can be as little as you wish it to be, or as generous as you're willing to be, because it is a wonderful organization and they do educate a lot of folks. Anyway, I'll be there for about 2 hours. I'll be talking a lot about the index funds, both traditional and non-traditional. I'm going to talk about the best one, two, three, four, five fund portfolios. I'll be talking about the future of financial literacy, talk a little bit about AI, what works and what might not work. And so I hope that you'll join us. And that again is Saturday, November 8th. Now, a few questions, and I want to go back just for a second to the question. I made the comment about the fellow who was questioning whether small cap value has lost its punch, and when I did write back to him, I told him about the lack of punch is a lifetime experience for small cap value. Now, be that what I'm talking about is, if you look at the telltale chart, we'll have a link to that chart. Uh, I think it's through mid last year. It doesn't matter what's happened since then, has not helped the small cap value catch up with the S&P 500. But in that telltale chart, you will see four 15 to 20-year periods where small cap value spent the time breaking even with the S&P 500. And so in my particular case, where I have half of the small cap portion of my portfolio, I've got 25% in small cap in the equity portion, lots of bonds, of course. But the small cap value represents half of the small that I have, and the small represents 25% of all of the equities. And what I know is at age 82, maybe if I get 10 years, that would be a miracle. That'd be wonderful. And there's a probability that small cap value might not make more than large cap blend over that period of time. But I am not investing that money for me. We are investing that money for those who survive us. So if it fails to make me smile, we will continue to keep it because we do believe that in the long term, it will be like the past. And that is long periods of mediocrity, if you want to look at it like that. Didn't mean you had a bad return. You just didn't get a premium over the S&P 500 for that 15 to 20 year period. And then, like magic, it hits, and for 3 to 10 years, it's crazy good. And it is during that period of time, then there is the extra return that makes it worth taking the extra risk. And by the way, the academics tell us, they tell us that small cap and value are built to produce higher returns because they are more risky. And of course, what we all know is we know the implication that one stock at a time is really risky. But if you have 500 individual companies together, all of a sudden the risk is much, much lower. But all of those stocks are going to go through a period of underperformance. But it turns out the academics have convinced us that that is true of equity asset classes, that there are periods they stink, and there are periods that they just do amazing things to create the premium that makes it worth owning them for the long term. And I've talked about it recently. For 16 years, the NASDAQ did not get back to where it was in 2000. It took 16 years. And of course, that means that many of the companies, if not most of the companies that are in the NASDAQ, were having the same problem, catching up, getting back to where they were many, many years before. And so the whole idea is probably for most people not to have all their money in NASDAQ, not all their money in the small cap value. In fact, really not all their money in the S&P 500. And over time, that premium should show up, but it just may not be in my lifetime. That is what I think it's important for this fellow who wrote to me to understand, is that you really do need to be very patient. And by the way, when I took out my quilt chart, and if you want to have some fun, now you may not consider this fun, but I decided to take another look at that quilt chart and see if I could find anything that surprised me. And I was surprised to find out that from 1974 through 1983, there was only 1 year that small cap value didn't outproduce the S&P 500. And the average, and by the way, that 1 year, it only underproduced it by 7.6%. Because if you look at all of these years from 1974 to 83, for all of those years, the difference on average between the S&P 500 and the small cap value as viewed by Fama and French in their index work, small cap value index, it was an 18% difference in return on average. 10 versus 28, 20 versus 38. And so It was obviously a golden age. There was also a golden age from 2000 through 2007 or so. Again, huge returns compared to in fact, from 2000 to 2004, the average return of the difference in return was about 27% for that 5 year run. So I think if you hang around, but we don't know, we can never know. Nobody knows the future. So there's one question I wanted to address today. Did you want to add anything to that, you guys?
Oh, the Fama Friends Eugene Fama comment comes to mind. You're not very patient, are you?
That's right. There you go.
It takes a lot of patience. It takes a
That's
lot of
right.
patience. Yeah.
Yeah. I guess the one other thing I might add, and this gets a little bit back to your original philosophy, maybe, Paul, is that the longer your experience base in the market, the less dramatic some of these periods of non or equivalent performance to the S&P 500 or the total market are. If you start young and you invest periodically and you watch how things go, you will get used to these ups and downs and the volatility involved in some of the portfolios. It's more in some and less in others. But as you become experienced in those fluctuations early in your investment life, when you don't have a lot of, or don't have a large portfolio, you will become more accepting is maybe not the right word, but more tolerant of them later when you do have a larger portfolio, because you've seen what's happened in the past and you become used to how the market responds and fluctuates. I forgot who said it, but when asked what the market would do, he said it would fluctuate. Well, it does. And so the longer you have an experience base with that, you will see how those things work out, and you will become less able or less apt to make rash decisions when those things happen.
Well, and I love that young investors who start with a small balance and dollar cost average into the account see even less volatility. So they
Right.
have these training wheels kind of on the
Yeah.
bike that help smooth the ride so that they are more likely to have a good experience and develop the commitment to the right behavior. So I totally agree with you, Daryl, that it's that experience that gives you a lack of surprise, right? It makes you a little bit calmer, a lack of surprise that things come in and out of favor because you've seen it before. Yeah.
Yeah,
And
exactly.
I do think if you do understand the nature of the market, you are going to make the right decision and be prepared to manage that decision when that portfolio that you've built up to some number, it's a magic number, it's different with every person. But I would have people come to me when I was an investment advisor, in some cases with 100,000, in some cases it was several million, but they would say, I've been comfortable managing up to this point, but it's gotten to be a bigger deal. And I'm not so sure that I can handle it anymore, and I'd like to find somebody to do it for me. You have, with that decision, uh, lost. And when I say lost, you are going to pay for something that we are hoping that you will be able to handle as easily with a million as you handled with the first $1,000 you invested, because things don't actually change. If you have a diversified portfolio starting out, and we're hoping that when you do start investing or your kids start investing for the first time, that they aren't chasing speculations, but rather are investing and doing the right thing right out of the gate, which is, I hope, that you will forward the PDF of We're Talking Millions, forward the PDF of Two Funds for Life, and forward Spending Your Way to Wealth. It is not about how to put together a portfolio. It is how to deal with the dozens of emotional challenges that investors have to deal with. And that too is free. They're all free at paulmerriman.com in the form of a PDF. So not only can you read it, but you can forward it to others in your family that might be benefited from it. So, gentlemen, do you have any other topic that on your agenda in your pile of lists? I've got one more. If our
Keep going.
if okay, this
Go
is for
for it.
people. This is for people who are thinking they might want to use market timing at the top of the market to try to protect their money. I got a long email. I loved it because I've been studying market timing since the mid 1960s and find it a fascinating way to manage money. But it is almost, well, it is. It's the hardest way to do it because it comes with so many challenges to investors. Because any market timing system is going to have times that it's totally wrong, and then maybe it'll be right for a while, and then it's totally wrong again. And after a while, you just get worn down that it feels like it's not worth being wrong as much as you have to be when you use market timing. But I will tell you that everybody who understands market timing can sell it easily because it sounds like financial nirvana. We'll have you in the market when it's going up. We'll have you out of the market, safe away from all of the losses when it's going down. And we have a strategy to do that. The problem is the strategies are always imperfect. In fact, if you look at the decision to invest in the S&P 500 instead of the individual stocks, you'd find the same problem. You would find that it is fraught with danger if you only own a few stocks in your portfolio. But it's the free lunch. You get basically the 10% in equities with the S&P 500, but you own 500 companies. Well, in a sense, when you're using market timing, you're going to have these periods when you're out of the market and it's going up. Other periods you'll be in the market and it's still going down and you're not out. And market timers almost always oversell how good, how accurate market timing is. This gentleman he reached the point. His portfolio got to $2 million, and he was nervous about managing 2 million, and he talked with financial planners, and the one that made the most sense was a market timer. And then, of course, he, the investor, as so many investors who use market timing find out, is they had expectations that were unrealistic because the timer didn't tell them the truth. In fact, the timer used an old trick that timers can use if they want to, if they're not straight up. If they have a bad period, maybe a year or two, and they underperform, they come up with a new system that has performed better because now they've again they've upgraded the past information, and the new system worked well in the last few years. The old system didn't. And this is what happened to this guy. He says when the client got frustrated that he wasn't in the market, the person who was the manager says, well, the indicators are in because I've got a new turbo model. Turbo model. I mean, who wouldn't want to be in a turbo model that makes money when the market's going up and protects you when the market's going down? Just be so careful to being trapped by the market timing approach to managing money. It isn't because it doesn't work. It does work. I have half of my money managed with market timing, but I know the downside of timing. And the reality is, if you are looking for the return of a 50-50 buy and hold strategy, you will get that approximately, not exactly, with a 70% equity, 30% fixed income market timing strategy using a typical trend following model. In other words, that because that 70-30 is out of the market part of the time, it ends up having about the same risk as the 50-50 buy and hold. But for some people, like myself, I'd like to have some timing in my portfolio to protect against the catastrophic. When people ask me the biggest mistake I've ever made, my answer has typically been I've been too defensive. When I started investing, it was one of the worst times. The market would go up and come back down, go up and come back down. It did that from about 1966 until 1982. And so it was easy to think that one should try to find a defensive way to manage that kind of volatility. Well, I would have been better being all in buy and hold. You know that afterwards. You don't know that before. So, do you guys have such a story about your past experience that you've ever had to deal with being on the wrong side of life for a long period of time until you finally got it right?
Oh, lots of them.
Can you share one?
Well, the biggest one for us was probably I was an employee for Hewlett Packard for 20 plus years, and we had a pretty heavy concentrated position in HP. And I remember sitting across the table with my manager, uh, Boris. And Boris looked at me, and we were at an all-time high. And he said, you might want to take some risk off the table. And I said, I'm just buy and hold, you know. And we rode it from 130 something down to 10-ish, you know. And so that was a one of many. We've made so many, but you know, it really is true that in the world of finance, if you do 80 or 90% of the things right, those few mistakes you make along the way aren't going to make the difference between success and failure. You're gonna come out okay, and we did. But boy, you get scars and you learn, right?
Yeah.
I have a question for you though on the market timing. You do yours through the Merriman Foundation, which requires that you sign up to have your money managed by them. You've talked to Meb Faber at Cambria about he has a trend following set of funds. Could somebody who's interested in being a little bit more defensive and having the meaningful diversification that comes from some trend following in their portfolio, could they do that with one of the funds at Cambria? Would that be
Absolutely. Absolutely.
reasonable?
Yeah. And they can,
I,
by the
I
way,
just,
they
I
can
just,
do it.
I just want to make one comment, Chris. You said he invests through the Merriman Foundation,
Oh, I'm sorry.
and
Yeah, no,
and
that
that's not true. Yeah,
no. Yeah,
we
no,
don't
he
do investing,
invests, yeah,
right?
through your old Merriman firm.
Right.
Yes, the old
Yes.
Merriman Financial
Yes.
Management firm. Yes.
Yes, they do it. And Med Faber knows more about market timing than I do. So personally, uh,
And what you would be giving up if you sign up for that, you get meaningful diversification, but in a steady bull market like what we've had, you
right.
would expect your trend following fund to underperform, right?
Exactly.
Just like small
Exactly.
cap value underperforms when large cap blend is shooting the lights out.
Yep.
So it is meaningful diversification, but it's like you said, it's more defense, more defense. And so you're probably going to have a lower expected return, but potentially a little bit higher return per unit of risk. Yeah.
Yeah. And thank you for that, Chris. And Daryl, anything you want to, I don't think you've ever made a mistake that you'd want to share.
Well, I've made one. Um, I've investigated a lot of things that when I looked at them in more detail, they turned out to be based on some shall we say, maybe dubious assumptions. Um, but the one issue or the one foray I had into doing something that I probably shouldn't have done was in the, I don't know, it's probably late 80s, early 90s. Everything was going nuts. And I became greedy. Okay. And so I gave an investor, a financial investor. I gave him a chunk of our portfolio, and I gave him total discretion to do whatever he wanted to do with it.
Yeah.
And it turns out he wasn't as smart as he thought he was.
Yeah.
And so, he wasn't as smart as I thought he was. Maybe that's a better way to put it. I'm sure he knew how smart he was, but I didn't. And that did not turn out well. Fortunately, the one thing that I did do with that was, after a few years, I looked at it and I realized that this guy doesn't know as much as he thinks he knows. And so we got out of that. So we were only in that for a relatively few number of years, and we lost a chunk during a time when most everybody else wasn't, or at least the market wasn't. And but you got to do things like that. It seems like once in a while you got to get a few scars, and when you do that, you sort of toughen up, and you learn a few lessons, I think.
And of course, we're at risk of not really knowing whether we did learn the right lesson. I mean, that's oftentimes when uh, parents will say it's good for their kids to get out there and invest maybe in individual stocks and learn about the ups and downs of the market. And in reality, I'm not sure how much you really learn that's meaningful, because a lot of young people don't know about the implications of proper diversification, and they may think the reason they lost money was because somebody misled them, or any number of stories that could be made up of what the lesson should be. And in essence, what we really want the young people to do is invest as if they have $1 million, and do the right thing from day one. And most people who have $1 million and more invest in relatively boring ways that have a tendency over the long term to be in their best interest. And so, uh, yeah, we all have to go through that period of learning, and you guys are such great teachers. Thank you for your help today, as always. And is there anything else you want to cover today, Chris, before we wrap it up? If you have anything on your mind.
Oh, I'd just love to get feedback from our viewers, right? So if they have any comments, love to see them in the comments section below, especially on our future plans, our priorities, things that they'd like to see us to work on. Any questions at all, we appreciate that.
Spot on.
Yep.
Thank you. Thank you both. I really appreciate it. And we'll see you soon.